Urgent trade alert, December 15th, 2022. Our high risk portfolio is up 15.5% total return year to date. This outperforms the S&P 500 by 3,500%. The S&P 500 is down 18.5% while we're up. If you compare us to the NASDAQ, we've outperformed the NASDAQ by 4,174%. We're expecting a massive deflation wave incoming. The best way to make money from this will be being long digital assets, tech, and long bond. This is how you get rich in 2023. Hedge with natural gas and oil to protect against an inflation impulse in highly underproduced commodities. Buy these 5 stocks now. So currently, the unit of investment for our high-risk portfolio comes in at $2,036. We've decided to make no changes for the year. I'll explain this more. But currently, per unit, you're buying 19 shares of the crash insurance, UVXY, 97 shares of the triple leveraged long bond, the US Treasury, TMF, 74 shares of ETHE, the Grayscale Trust, giving you exposure to our favorite digital asset, 1 share of FNGU, these are the big tech giants, leveraged times 3. We'll be likely adding to that position next year. And then 12 shares of Boyle, betting on the price of natural gas in the US going up due to the conflict in Europe. Okay, top headlines. Santa Yellen, this is on the Drudge Report, inflation will be much lower next year. I agree. Now we're expecting in either the February or March meeting for the Federal Reserve to pause interest rate hikes. We had Powell come out yesterday claiming they're going to keep jacking rates up, and the bond market is saying, yeah, right. So I think we're going to see a low CPI in January and February and start to see the melt up we've been anticipating as that occurs. So again, a lot of people point out when the Fed pivots and drops interest rates, it's a bad time to buy stocks. We'd agree. We're expecting them to pause. And typically this is a beautiful time. In fact, in this chart, we're looking at the returns when they paused, gains of 104%, 39%, 166%, 11%, 28%, and 44%. Here's a look at this on a graph and chart. So you can see when the Fed did their last tightening is when you get a really nice rally in markets. We had the biggest drop year over year on the CPI. This is now 2 months of the CPI falling aggressively, which is what we were anticipating happening. If we look at this, it's dropped to 6%, and it won't be long till we're heading down towards 4 to 3%. I think we're going to see it bottom out in 2023 around that 3%. So with the federal funds rate getting ready to get jacked up towards 5%, it's going to be a massive, massive problem if they do that, which again, I don't think they will. This chart from Goldman Sachs is comparing a heat map of inflation from October to November. Blue or white represents cooling, and red represents heating and of inflation. So you can see there's very, very little that's still going up month over month, and it's primarily in food, services, and rent. And we know for sure the rent is about to crash because they're using data that's 6 months old while we're looking at real-time data. This chart's looking at the CPI, PPI, and M2 money growth. And we can see the money growth, which is leading by 16 months, is showing us we've got a good year and a half of deflation incoming due to the last 16 months of not adding to the money supply. Another way to predict that the Fed's about done is looking at manufacturing ISM data. And almost always when it gets to this level, they stop and pause. This is the bond market compared to the Fed's forecast. And so we can see the Fed's forecast in yellow heading to 5.25 terminal rate, while the bond market is laughing at that and starting to decline. So we're already at the point where the 2-year is going to be below the federal funds rate. Here's a breakdown of the inflation data. And again, the primary problems in the inflation month over month with positive readings. We're in the shelter in place up 0.6. We know that's going to be crashing hard. Medical services still rising slightly, but that sector has been crashing as well. And then we've got food. So we're still seeing food rising month over month. This chart's looking at the rental index with the data and the mortgage rates. And we can see for the last, really for the last 6 months, rent is falling rapidly. Again, this is going to be very good for a lower CPI. This is looking at a breakdown of inflation drivers. So first we had the Fed printing money in the dark blue. That's done. In fact, now they're doing the opposite with quantitative tightening. We got the government stimulus in orange. That's been dramatically reduced. Supply chain issues have become fixed in gray. The war, which initially drove commodities up, no longer is doing so. We've had oil fall from 130 down towards 75. So that's the primary inflation drivers, and they're all gone. This is looking at inflation that was over 4% on different categories. And you can see that index of highly inflationary assets are also falling for the last several months as well. Now, the best time to buy is typically at peak inflation. And so I believe we've reached that several months ago, and we'll see a falling CPI for the remainder of this year. In fact, this is looking at average months from peak in some of the inflationary periods of the 70s. And it looks like we have a very similar trend here. Another reason why the Fed can't keep interest rates at this level is because our current interest rate payments is approaching that of our budget for the military. So this is completely unsustainable. We cannot roll over $31 trillion in debt at 5% interest rates. It is just not possible. Now, another argument a lot of the inflationists make is that the wages are rising so rapidly that it's going to drive structural inflation long term. But the problem is there's a lot less people working to drive that, and the rate of change of earnings is far below the inflation rate. So even though they're getting a nice raise, they're still not making enough money to offset the increase in cost of goods. And this is showing real average earnings over the last 2 years have been negative. This is problematic and most likely going to resolve itself as people draw down their savings. There's still a lot of savings in the economy, and their income versus credit is still at record levels in terms of being very good. But you can see a percentage of people working after the lockdowns is down a couple million people. So to really recover the labor markets and to get wages to flatline and stop rising, we're going to need to see the labor force participation rate slowly get back higher. Here's a look at the employment cost index, which you can see is rising, but once again, relative to the inflation rate, it's not keeping up. Okay, so some things that worry us and why we're hedging with either oil or natural gas is that the administration has been artificially driving the cost of oil lower by dumping our strategic petroleum reserve. Also, China's been in a crazy lockdown and now they're reopening. So we do see a return in energy inflation, and it's going to be a key hedge to your portfolio and actually how we made all our money this year going back and forth between oil and natural gas. Now, on the natural gas front, we're primarily betting that Europe is going to buy lots of American natural gas because they've stopped buying it from Russia. To do so, we go along the ticker BOIL. And our strategy has been pretty simple. Wait till they fill up their reserves to get in at low prices, and then wait till they deplete them to sell where we anticipate higher prices. So I think we're going to be able to double our money on BOIL again, probably by February. A lot of this will depend on weather. The colder it is in America or Europe, we got a big cold front hitting Asia currently. The faster these levels get depleted and the quicker we can get out of BOIL and hopefully back into the oil play. So we can see they're starting to deplete those levels. We were buying as they were filling up to 100%, and they're starting to draw down on that. The German government's anticipated with the cold winter, they could be completely out of gas by February or March. So that's likely our timing to get out. So looking at the gas storage versus net withdrawals. And again, we're starting to see that they're making the withdrawals in blue. This is a little chart showing you the best returns of various assets. And one of our favorite assets are digital assets. Ticker BTC is the big one, but we like ETHE better. And what I want you to note is the best returning asset over the last decade has been BTC without question. Nothing's come even close. And the years that it didn't win the race, it was the worst performing asset. So the trend has been 3 years of top performance, 1 year of underperformance. 3 years of top performance, 1 year of underperformance. Well, you got your 1 year of underperformance. Time to get very aggressive in the new year in this asset. On the economic side, people are saying we're heading into a catastrophe in the economy. I'm not seeing that. As long as the Fed does the pause, I think the economy is going to run just fine. So we're looking at consumer spending continuing to be healthy and growing. As far as us importing goods and services, we're keeping that up nice and healthy. Retail sales did fall a little bit. That's good. We need to cool off the market, just not crash it. So we saw a little decline in retail sales. Consumer credit continues to grow. Credit versus income is at extreme lows. In fact, record lows. So the consumer can borrow a lot more money. This is not ending anytime soon. China's PMI below 50 because they've been in lockdown. Expect that to jump back up. That's going to jumpstart the economy and continue to fix supply chains. Again, the main hedge there is energy. They're going to need a lot of energy that compared to what they've been doing over the last several months. China's exports still healthy and imports still healthy. So we're not seeing some sort of global crash. Now, if you're not a paid member and you want to get our next trade alert, call Dean now at 505-322-7515. Also, if you're a portfolio builder member, you should be getting out of ETHE, GBTC, and replace it with our private equity product, Rebel Dividends. There's still our favorite product for exposure to that digital asset in the stock market, but unfortunately, it's just dramatically underperforming the real thing. With Rebel Dividends, I do the work for you to get the real asset and provide 2-to-1 leverage. So for every dollar you have in Rebel Dividends, you're going to get $2 of real exposure to ETH. Okay, let's go through the trade alerts step by step for 1 unit of investment. Again, if you log into the membership area, you can punch in how much money you want to invest. It'll auto calculate what to do. Buy 74 shares of ETHE. This is down 78% year to date. I think we're bottoming out and getting ready for a big rally. Here's the performance year to date. Again, just a catastrophic drop. This is a buy the blood on the street moment. Now, the main reason we like digital assets is we believe governments globally are trapped and they're going to keep growing debt. This shows you the debt growth globally to $250 trillion in 50 years. Okay, so they've went from 100 trillion in the 70s to 250, and it's growing exponentially. This is U.S. federal budget's deficit projections, and they want to grow the deficit to $2 trillion this decade. They're not going to do it with interest rates remaining at this level. So if interest rates are going to be crashed for a decade, the best asset is these digital assets. And here's a look at some examples of when the TLT had crashed in the past and recovered, the type of returns we saw in various digital assets. So this example was just before this bear market entered. And again, in 2021, and we saw ETHE go up 114%. Now, again, in Rebel Dividends, we're going to not just get ETHE, we're going to get the applications being designed on ETHE. So Polygon up 525%, Link up 400%, Aave up 900%, Curve up 310%. In this chart, we're looking at the modeling for predicting highs and lows in digital assets. And it's based on the bond cycle and the halving cycle, which reduces which doubles the cost to mine BTC. And again, we're having to not say the real word because of censorship. So that's why we're using BTC and ETH. Anyways, this is expecting the bond market to hit low yields and a high in digital assets around 2025. Step 2, buy 12 shares of BOIL, the war inflation hedge. So we can see Boyle over the last 3 months, crash 55. We've been buying the dip over the last month, and I'm expecting it to go back towards 90 to dump. Today it's at 36.45, so we're going to nearly hit a triple on that if my prediction is correct. The other play we've made money on this year has been NRGU. It's the big oil and gas companies in the US, leverage times 3. We just got out of that for a huge gain. We've seen the price of oil crash much more than the price of oil stocks. So I'm waiting for a pullback on that before we go back long NRGU. Right now, the risk reward on the natural gas spot price is much more exciting to me because we do see that the war is unfortunately escalating and getting ready to go into very aggressive mode in the coming year. Here's that sell-off in oil. Again, the sell-off in oil relative to the sell-off in energy stocks is not matching up. That's why we're waiting to get back into NRGU. Here's Exxon, and a great example. So even though energy sold off rapidly in terms of oil price, Exxon sits near all-time highs at 104. Next step, buy some crash insurance. Not expecting a big crash unless the Fed overdoes it on the February-March meetings or we get a hot CPI print. So if I'm wrong and the inflation is going to start roaring back up in January, February, the Fed's going to is going to give guidance for a lot more rate hikes, and we're going to have a big problem on our hands. As long as the inflation's falling January, February, and we're starting to see the labor force participation rate tick up and wages slow down, I anticipate epic rally here. So we're light on this position. If we get the different data than I'm expecting, we can load up more aggressively on UVXY. UVXY is down 20% in the past month, 28% in the last 3 months. The reason we get it is for big crashes. So in March of 2020, when the world went into lockdown, S&P 500 fell 25%, and this product went up over 1,000%. So a 10% hedge doubled your account just from that single play. This is the analog of the VIX against 2008. And again, the only thing that I see really causing a big drawdown would be being wrong on the inflation data, which again, so far is really falling fast in all sectors. Okay, bonds, 97 shares, TMF. This is our safe play to make big money till about 2025, expecting interest rates are going to be driven lower so governments can raise debt. Here's the trend of the TLT, which TMF plays times 3. It's a 2-year bear market. This is the biggest crash in the US bond market over the longest stretch of time. And I don't have a higher conviction on an easy way to make money than with TMF. And that's why that's our single largest position currently. Okay, we're seeing a recovery in the investment grade bond ETF LQD. We have no position. The high grade bond market, the junk grade bond market with HYG, we don't have a position, but we're seeing recovery in bonds just about everywhere. This is looking at the 3-month treasury. And again, all these bonds are below the federal funds rate. So we're currently in the range of 4.25 to 4.5. So this is the only bond that's in that range. Everything else is falling way below it. So the bond market is calling BS. The Fed must stop and eventually cut. So we're expecting them to pause for probably a year before needing to cut. And so again, this should be a very good time to be long our favorite assets. Here's the 2-year, again, just slightly below the federal funds rate, which is again, the low band of 4.25. Almost always the 2-year dictates what the Fed will do. Here's a big picture of the 10-year treasury. And again, you can see that uncontrollable inflation in the 70s. That was driven by a rising labor force and lots of manufacturing in the US. We're just not doing that. We are starting to onshore some manufacturing, but our labor force is just not growing. So I do not see a sustainable inflation trend. Here's the 30-year treasury over a 20-year period. And you can see the trend is lower and lower and lower rates. The key driver of this is the growth of debt. And as long as the government wants to grow its debt, they'll have to drive these interest rates lower over time. Some of the contagion from Europe, we're watching their bond markets. They're starting to top off with the Italian 30-year. We can see has been falling for 3 months. Also, remember when wood was outrageous due to a housing boom? Well, that's over. Lumber futures, which topped out something at like 1,200, now down to 388, down 68% year to date. Copper is hanging in there at a high level, but not nearly as high as it was topping out last year. Baltic Dry Index back to normal levels. This went to insane prices for a little bit, up in the 5,000 range, back down to normal trend at 1,400, down 38% year to date. Wheat down 9% in the last 3 months. And again, we can look at previous inflation spikes, but what typically comes after inflation is aggressive deflation. So as long as the Fed doesn't overdo it and pauses, we're looking at a really good Goldilocks situation for 2023, 2024, and probably top out in 2025. Initial claims aren't picking up, so we still have this very robust labor market. There's just not enough people relative to the jobs. The yield curve's inverted. This is typically peak interest rates. And again, so here we have it. They have hiked above the 2-year and way above the 10-year. Okay, this year we're long the dollar for quite some time and made good money on that. We're not long the dollar right now, but we do look at the chart. So what I want you to know is DXY, which is really the dollar against the euro and the yen. The highs over the last several decades become lower and lower, and the lows are becoming lower and lower. So if you're looking for BTC to hit 200,000, we want to see the DXY drop towards 90. If it goes towards 70 or 60 over the next decade, you could be hitting some 7-figure prices on BTC. So a very exciting trend. And this is primarily driven by the US government's debt growing exponentially over time. Here's the dollar against the euro, gaining 15% this year, but starting to give that back. Here's the dollar against the yen, appreciating 20%, but again, giving some of that back. And then the dollar against the yuan, gaining 9% against the yuan. Now, again, all these countries have been waiting to do stimulus till the US inflation was rolling over so that they wouldn't collapse their currencies. So as the inflation does roll over globally, expect central banks to ease financial conditions and pump markets, which is crucial for tax receipts. Okay, buy one share of F&GU. We'll probably be adding to this. Unfortunately, there's not a great product for exposure to digital assets right now. The SEC blocked ETHE to convert into an ETF, which would have closed that discount window. Right now, it's trading at half its real value. And there's some insolvencies related to that. So I'm carefully monitoring that situation before we add to it. If the problem is resolved, ETHE could explode to the upside. But again, we'd recommend going to Rebel Dividends so you don't have to worry about these companies that have some debt issues to the tune of billions of dollars. So I now am more interested in F&GU to add to our positioning for Portfolio Builder. And again, Rebel Dividends can replace both the F&GU, ETHE, and GBTC position for far better gains. Okay, we're looking at some indexes. SPY, this is this morning, so it did sell off more, down 16% year to date. NASDAQ down 27, emerging markets down 22. This chart showing the outperformance of emerging markets each cycle. We're actually expecting as the dollar falls and interest rates to fall, that emerging markets will outperform US markets once again. So in our safe growth strategy, you have EDC for that exposure. High risk has some Asian exposure through F&GU. The European index, actually not so bad. We're looking for some sort of Great Depression contagion that we last saw post-World War I, when the world went after Germany for reparations to the tune of bankrupting their currency, and it caused the Great Depression. So we're just not seeing this underperformance in Europe to anticipate that sort of problem. Uranium, URA, we're not in right now. We'll get back to it, down 20% year to date. We're not in rare earth metals right now. It's down 23% year to date. Some individual stocks, Amazon down 45% year to date, Apple down 20, Alibaba down 33 this year and 50 last year. So there's some screaming deals, and I believe we're very close to bottoming out. What we need, again, is to see the CPI continuing to fall in January and February ahead of the next FOMC meeting. Okay, very good. So I'm going to go ahead and take questions and look at our risk calculator. Okay, so here's the risk calculator. We're hanging on to our positions currently. I believe we can sell Boyle in February in both portfolios and probably roll those into NRGU, most likely. And if we get another good CPI print, I'll likely shave off some treasuries, add to UVXY, and then add to some of our stock or GBTC positions for the safe growth. For high risk, we're most likely going to sell some treasuries, top up UVXY, and then add to F and GU. So that's really the two trades I'm looking at. If everything clears out for the Grayscale Trust and its parent company DCB, I'll get more bullish on ETHE for the portfolio builder strategy. Okay, let's look at questions. Yeah, I'm still holding ETHE and GBTC at a quantity I find good for each portfolio. So I haven't told you to sell those. I would replace those with Rebel dividends if you feel safe with me managing that position for you. But the discount window is at 50% nearly for these two products. So it's just, you're getting exposure to these assets at half off, assuming they can close that gap, which is a big assumption. Steven says, why do we have TMF in the high risk portfolio? TMF is in both portfolios because I think it's the single best asset to own over the next 2.5 years for the least risk. And that's why it represents 40% of the portfolio. So Don says, why would, yeah, so I'm expecting rates to fall for 2.5 years, guys. So you want to buy tech during falling interest rates. Ron says, you said, so yeah, I like F and GU. I like Rebel dividends even better. So Rebel dividends represents extremely leveraged tech play. So I look at ETHE, GBTC, F and GU as the same play as Rebel dividends. Peter says, are you bearish on gold or silver? The central banks have been buying record amounts of gold. And there's a rumor that Putin's going to start selling oil for gold. So I've been definitely watching that. The problem is, again, you're playing some paper product that banks manipulate lower relative to spot. And so at this point, we haven't made any moves into gold or silver. And yeah, we've been getting IRA accounts into Rebel dividends. So call Dean if you have an IRA and you want to move some of that money into Rebel. Mary says, why are we holding ETHE and GBTC with the risk from Grayscale? Well, I think the discount window is going to bottom out here. And if the outlook for, basically the story behind this is DCB owes Genesis something like a couple $2 billion. And so the revenue from Grayscale Trust is at $200 million a year. So they're trying to raise money, about $1.5 billion, so that against the revenue of the Grayscale Trust. So if they can close that equity raise, I think that window is going to close. The only other alternative is Coin, which has been performing horribly, Coinbase. So yeah, this all happened so quickly. So I've been watching this very carefully. And yeah, I just don't want to sell at the very, very bottom when it may be getting ready to bounce. But again, to replace that position, I would, and if we were in F and G, we wouldn't have had any better return. So we want that tech exposure, and so that's why we've held through this drawdown. But yeah, coin is a potential alternative, or FNGU. But again, FNG is not a digital asset, but it's just the 12 large tech companies leverage times 3. Steven says, aren't grantors trusts supposed to be more regulated than ETF? No, we want the Grayscale Trust to convert to an ETF, because then they can make the price match the value of the assets. We now have basically a 50. They're selling shares for half of the value that they hold. So it's a screaming deal long term. So there's, one option is Regulation M. They close the whole fund, and all the shareholders get rights to basically half off digital assets. The other potential is they close the funding, and the outlook for them having to dump a bunch of this to pay Genesis is reduced. But yeah, this was all kept secret. So everybody thought it was just going to trade near the value of the assets. And all these people had exposure to the 3AC blow up or FTX. Marissa says, if I'm down on ETHE, would it still make sense to sell and put that into? Yeah, so sell before the end of the year so you can have a tax write-off, and then rotate that into Rebel. Absolutely. Then you don't have to worry about any of that. You'll get 2 times the return and not have to worry about the debt owed from DCB to Genesis creditors. And you can use your IRA. We've now closed 2 deals with, or 3 deals with IRAs. But yeah, right now ETHE trades at the whim of the market, and it's not tied directly to. So for the beginning of ETHE, it was trading at a premium. So you're paying more than it was actually worth. And then once the bear market entered, it's slowly been trading at a discount. And the discounts today is greater than it's ever been. In the past month, it's down 20% more than ETH is. Also, this will be the final webinar of the year for Portfolio Builder. We'll have one more Rebel Dividend webinar. We're going to take the last week of the month off, and then the first week of January, we'll be back. I don't anticipate any trades. We'll still be doing the daily updates. And if there is a trade alert, I will host a webinar. But I'm extremely confident inflation is going to fall, that the Fed's going to pause, and that we're really well positioned with the current holdings. And the only change I want to make at the right time is to sell some TMF and put it into either ETHE, GBTC, FNGU, or the triple Q. So a tech play, betting on interest rates falling. I believe the Fed just wanted to ensure the CPI continues to fall January, February, so they can execute the pivot safely come February or March. So I'm expecting a pause by the Fed in January or March. What we had instead was this talk of more rate hikes. And then we had the ECB come out with a 50 basis point rate hike and a $15 billion a month roll off starting in March, which is not that big. Yeah, John, we're going to probably do a trailer around the January CPI. Assuming it goes down, I'm going to expect the Fed pauses in February or March. So we're going to front run that. If I'm wrong and the CPI is not falling, we're positioned exactly how I'd like right now. So we'll add to our tech play as soon as we get a third consecutive CPI input that's falling. So if we get a big drop in inflation on the January CPI, I'd like to rotate some of our treasuries into the higher risk strategy of being long tech. So that would be triple Q, GBTC for the safe growth, and for the high risk would be ETHE and FNGU. Also, in February or March, I anticipate selling Boyle and potentially rotating that into NRGU. The Fed's meeting in February and March. There's no meeting in January. Yeah, TMF and Boyle, I believe, will do really well for us until we make this switch. And yeah, I mean, the last few days, those have been the only assets going up, TMF and Boyle. So we've been in the right place. Boyle's been obviously bopping up and down like a maniac. But again, I expect it to do very well by February, March to sell. Hopefully get back to that 90 for a third sell around the 90 mark on Boyle for us in the last year, plus a couple months. So again, no webinar for Portfolio Builder unless we do a trade alert. Take it easy. You're set to jet. You're in the safest asset over the next 2 years, TMF, with the bulk of your portfolio. And we've got the inflation hedge with Boyle. We've got small exposure to stocks. And we've got a small exposure to UVXY. If there's anything dramatic to change, I'll do a trade alert and host a webinar the day of. Yeah, cold weather in the US, Europe, or Asia will be the main driver of Boyle. All right, guys, we'll have a great Christmas. You can always email me questions at support@portfoliobuilder.io. If you want to move some IRA or cash to Rebel Dividends, call Dean, 505-322-7515. Next week, we'll have a Rebel Dividend webinar and dividend, and then we'll be back after the new year. So Merry Christmas and have a great New Year, guys.